Again, thank you very much for joining us with our first WieldMore risk management webinar for next year, 2023. In the webinar, we will talk, as I said, about opportunity for small and medium enterprises. The thing that I really proud to say, first of all, is that WieldMore is a financial conduct authority regulated company. And second, that United Nations Principle for Responsible Investment is our guideline for our sustainable effort, and we are a proud signatory of the United Nations Principle for Responsible Investment. So in the own words of the Financial Conduct Authority, firms must act to deliver good outcomes for retail customers. This imposes a higher and more exacting standard of care than the principle of treating customers fairly. So this is in the own words, again, of the Financial Conduct Authority. What does it mean? Treating customer fairly, we all know what it is, but now we move on the next level, which is the consumer duty, which is the new regulation from the Financial Conduct Authority. And the focus again is on retail customers. So retail customers and small and medium enterprises, are they the same thing? Yes, absolutely, because the majority of the small and medium enterprises are extremely vulnerable and are considered an important part of our economy, an extremely important part of our economy, and as such, they need to be protected. In the next slide, we can look at what is important and what are the main points for our company. As WieldMore, we are, as I say, the Financial Conduct Authority, a regulated company. We are relatively young in terms of how long the company has been around. We've been we founded the company in 2019. But we have a nice round number of years of experience. We've been together working in this business for 100 years, and we had experience in in all major investment management firms or investment banking firms. The company is privately owned and is an independent company, which means that we are not going to commit to rebate fees or to contracts with other counterparties. We are absolutely selecting what is best for our clients in terms of prices and in terms of quality of services and products. So WieldMore journey has focused on essentially developing innovative, high quality, cost efficient solution. The reason why we're called WieldMore is because we wanted to make sure that our clients could wield more power when it comes to risk, when it comes to protecting, their business and their exposure. So the team is made of 9 people, and we've been all, as I said, working for major institutions. There is a positive news and a negative news on the fact that we've been around for so long. The positive news is that we have really experienced incredible moment in the history of financial services, starting from the Russian crisis in the 90s to Twin Towers, to what happened with the European crisis, to the recent COVID and Ukraine-Russia conflict. The negative is that we are all kind of advanced with our experience, but this is extremely important for the kind of risk that we are going to protect for our clients. Now, in the webinar that we are presenting today, there are 3 major points that we're going to talk about. The first one is the market outlook for the next few months. So we represent what is happening and what will be happening, in our opinion, for the next 6 to 12 months. Then we look at how risk is impacting small and medium enterprises, and what can we do to protect from this risk, and how our firm is helping a small medium enterprise to protect itself from these risks. And then finally, we talk about the professional financial advisors and how they can help small and medium enterprises. And also, which is the thing that I'm extremely concerned about, is the new consumer duty from the Financial Conduct Authority, which is creating an extra layer of attention and focus for the kind of customers we're talking about. But I'm now letting Terence McIver to introduce you the Microsoft Outlook, the outlook for the next few months. And thank you, Terence, and thank you for attending our room. Thank you.
Thanks, Giuseppe. So the market outlook for the next months. When looking back at 2022, I think we can all agree it's been a tough time for individuals and businesses. And this really started at the end of Q1 with Russia beginning its war on Ukraine. And this caused widespread fear in markets and rippled into commodities, namely natural gas, which we've come to understand how heavily relying the UK and Europe are on the commodity. And this was really the picture up to Q2 to Q3 when Russia eventually halted its gas supplies to Europe, resulting in natural gas prices reaching highs of almost 1,000% since the start of 2021. This increase in commodity prices, coupled with supply chain issues, is really started to drive up inflationary pressures, and which saw inflation in the UK growing to double digits in August. It's the first time in over 40 years. Now, this rapid increase in inflation in the world's major economies saw central banks start to accelerate its interest rate hikes, try to bring this down back to sustainable levels. And this is when we started to see volatility in exchange rates, with the euro falling below parity against the dollar, and for the pound depreciating around 3 to 5% against the world major currencies on the announcement of Liz Truss's new mini budget. Now, the main talking points at the moment really reside around the inflation prints, and as we start to find out whether monetary intervention is starting to work on reducing inflation. And the first signs that this may actually be appearing is in the US, where CPI came in at 7.7%, which was 0.3% lower than in the UK. Now, as we look in the slides here, the top graph actually shows the central bank policy rates since the financial crisis and up to now, and we can really see that we've been operating in a rather favourable environment with rates near low to zero in the last decade. And now the environment is very different. Interest rates have increased at a very rapid pace, and the cost of borrowing has grown, and also the cost of repaying existing variable rate debt has increased. And this has mainly been driven by the graph on the left, which you can see with the CPI change year on year. And up to June, we really saw a linear movement between the UK, the US, and the EU. And we've started to see a divergence with the US starting to slow down in the last few months, while the UK and the EU are still really increasing. And I think one of the questions is where is the market expectation of UK interest rates for the future? And on the graph, we can see on the right that market interest rates have changed a lot since July. And at the moment, market expects interest rates to peak at approximately 4.2%. However, these figures really do remain susceptible to changes, particularly as new inflation economic data does get released. Now, within exchange rates, sterling has been one of the worst performing currencies in 2022, but has regained some strengths in the last few months since Liz Truss's resignation and the announcement of Rishi Sunak, which has restored some credibility to the UK by the markets. And as on the graph on the left shows, sterling is down against all major currencies this year to date, apart from the Japanese yen, where the Bank of Japan are artificially keeping interest rates low. Now, as a trade deficit and import reliant country, especially for goods, UK businesses are impacted due to the depreciation in sterling, and it's something that we should definitely keep watching for the near future. Now, with commodities and companies who import commodities have been severely impacted as their prices in general have increased in 2022 and in a rather volatile fashion. Even excluding natural gas in this graph, the bulk of commodities here shown do remain rather volatile and are around the 15 to 25% up this year to date. And Copper is the only one here is actually showing us down, and that's primarily due to the fact that metals are largely influenced by the health of the global economy. And what we can take from this is that companies who are exposed to commodities and haven't put in place any hedging strategies this year have really had to make the difficult decision as to whether to absorb these increase in input costs and take a hit to their margins, or pass this on to consumers through higher prices. Now, it's also important to note that commodities and many commodities in the world are priced in US dollars. So therefore, UK-based companies and non-US based companies are also impacted by currency fluctuations when purchasing commodities. So now I'll pass it back to Giuseppe, who will talk about more about some of the strategies that businesses can put in place to protect against these market risks.
Thank you very much, Terence. So if we look at what can be achieved, trying to protect ourselves in terms of those risks, and the services and products that we can use, WieldMore is here to provide simple, transparent, comprehensive solutions. Essentially, what we focus on is how we protect ourselves. So there is a component of advice, and then we look at the execution. So we necessarily need to look at the costs of the execution, make sure that they are the lowest possible, and the kind of products and services that we are using are the one that are appropriate for the kind of risk that we want to protect. So the execution part of it, and then the accounting, which means that we have to look at the cash flows, for example, on the firm, and try to understand exactly how we match those cash flows. And then finally, the compliance from a regulatory point of view. We have to make sure that those derivatives are not only matching all the point that we described above, but also that we are able to go play along the regulatory limits that the regulator is imposing, which is in our case the Financial Conduct Authority. So which are those risks and why we hedge? So the risks are, as we anticipated, commodity risks and currency risk. And then there is another risk that we completely put on a side in the past, which was the interest rate risk. Now, interest rate risk in particular is important recently for the impact of inflation. Now, the impact of inflation, everybody's thinking about how this is going to affect our savings in our current account, which is obviously a big and important part of our life. But imagine, the other part of it, which is kind of hidden, about, the fact that the inflation is influencing the cost of human resources, the cost of the contracts for patents or for loans. So it's a huge impact on small and medium enterprises. Can we do anything to protect against this risk? Yes, we can. And the reason why we hedge is essentially because we want to protect those revenues. We want to make sure that the profitability and margins are consistent in time. We want to make sure that we are able to build stable pricing in our strategies so that we can budget for the next few years. And we want to focus on our business. I don't want to, be there exposed to all risks and, focus on something that is completely away from my everyday activity. So the way we can, manage this risk is essentially falling in two categories. There are those products that are helping us to achieve neutrality, and those products that are helping us to achieve optionality. So what does it mean that the small, medium enterprises can achieve neutrality or can achieve optionality? Essentially, neutrality means, as you can see in the graph on the left side, that wherever the market is going, I am mirroring this risk with a counter product, which is balancing these losses with a gain that is matching perfectly the other side of the world. So essentially, this is covering completely my costs, and the sum of the two is always zero. The products to achieve optionality instead is giving us the opportunity to cover our risk only when the risk materializes. So, for example, in this graph on the right, we have represented rates. So if rates stay below the dotted line, dotted gray line, we are safe. But if the rates go above the dotted line, then our risk materializes. In that case, we are protected because we have a strategy that is in protecting only for that specific risk. So that's why it's products to achieve optionality, because the optional risk might materialize, but I'm fine because this is covered in terms of exposure. So there are advantages and disadvantages to this strategy. So the advantage of the complete neutrality are the fact that is, wherever the market is going, I am completely protected, and this means that it might go, it might create some liabilities in terms of accounting, because when I am making money on the commercial side because my revenues are higher because of the currency exposure, my protection will be negative. So the objective in this case is only neutralizing completely the currency or the commodities or the interest rate move. On the other side, the optionality is interesting because it's giving me the opportunity to completely forget about the risk and then concentrate on my business without looking at where the market is going. But there is an upfront cost because it's like an insurance premium. And this is something we should consider. Now, in this case study, we represent what is happening on the currency hedge strategy. This is a real case where we had a company letting villas in Europe. The company is UK based, and this fancy traffic light that you see in the top right corner of your screen is representing what is happening when the company is taking decision on what to do with their risks in terms of currency risk. So the first line, the unhedged strategy, is when the company says, okay, let's do nothing and see what is happening. And this is when we have the market is going up or down. So the dollar might appreciate. And in that case, we're happy because we are, receiving dollars, or the dollar might depreciate on the right of the screen, and then, we're losing money. But we decided to do nothing. So this is what is happening. The dollar goes down, we, dollar depreciate, we lose money. Dollar appreciate, we make money. We are totally exposed to the risk. So if we use futures, is the neutral option we discovered before, which means that dotted gray point is representing the operational costs that we might entertain when we enter a position on a future, and we cover the exposure. And then there is the third and fourth line where we represent instead what is happening with the call option strategy and the collar strategy. The call option strategy is where we are essentially paying a premium, and this premium is protecting us against the risk. Now, what is happening is that if the dollar depreciates, we are protected against this event, and the red dot that is a little bit larger here is representing the cost that we entertain for making sure that this risk is protected. So the green bars on the left side of the screen for the call option strategy are representing instead what is happening if the market or the dollar is appreciating. So we're receiving bigger revenues, larger revenues, and that means that in this case, we're happy about the increased revenues, and we are not going to exercise our call. We rather abandon the call, and we don't need the insurance cover. Essentially, this is exactly what is happening when in real life we use insurance contracts. So the results are this kind of strategy provide the opportunity for the firm to protect and manage the financial risks, to execute the strategy, making sure that we have, very fair and transparent conditions, and is extremely simple to be represented. And we, as a WieldMore, make sure that those strategy are adapted also to what the firm and the market outlook are. In the following slide, we go a little bit more into the detail of the currency hedge when this is happening through an option contract. So what is happening here is that we look at what is the cost of, say, hedging, for example, a risk of $1 million. And these are the real numbers, essentially are the numbers that we can obtain today if we decide to cover the risk exposure of sterling dollar, where we want to make sure that the cost of securing my revenues in dollar is guaranteed by the protection of the call option. So in this case, you see I pay $8,850, which is the cost of the premium, which is representing less than 1% of my exposure, total exposure of $1 million. So that means that from 130 on, I am protected against the risk that the dollar is depreciating further. So for all of those that are thinking, well, I'm receiving dollar, I'm happy, I'm doing extremely well this year. It went down to 103 at one point, yes, but we don't know where it's next year. And from 103, that was the lowest point, to where we're now, 119, was a big move. So if we had planned our budget with this instrument, we would be able to have a much lower level of exposure and costs thanks to the protection that we can achieve with options. So the break-even will need to obviously consider the cost in the calculation of the total break-even exposure to the dollar pound movement. So the 131.18 that you see there on the screen is essentially those 8,850 added up to the 130 level of protection that the call option is guaranteeing. So in the following slide, we essentially look at the same exact market risk in terms of exposure, but this time is a commodity as a base. And again, we have a real case here of a company leading the metal components, leading in the market of metal components, and they are trying to cover their exposure in copper. Copper was one of the metals that went up dramatically immediately after the announcement of the war between Ukraine and Russia. And in the top right corner of your screen, you see the table representing essentially the level of losses the company would have incurred if they didn't protected their exposure. So didn't protect their exposure. And you see the first quarter, the second quarter 2021 up to the third quarter 2022, the total amount of losses for the first row is amounting to $1.5 million. So the overall coverage result is essentially the sum of covering both the exposure to copper, but also the exposure to the currency, because you have to bear in mind that the majority of the commodities are priced in dollars. So we not only have an exposure to the underlying commodity, but also we have an exposure to the currency. So the graph on the right bottom part of your screen is representing how the losses in both copper and currency are matched with the protection, essentially. So why we indicate here that there is 100% cover ratio is because we essentially can decide to cover the entire risk or to cover parts of the risk. Here is represented the protection for the entire exposure, so 100% cover ratio. So what is the WieldMore support in this case? We create a pre-analysis that is completely free. So we identify the risks and the components of this risk. Then we look at the impact of, as I say, the different cover ratios. So if you need to hedge the entire exposure or just partially. And then finally, we look at the risk management and the strategy that we need to put in place to manage cash flows and budget. Now, in this slide, we wanted to represent what is the difference between financial services companies regularly acting on services and products, protecting, this kind of risk. And what is happening to a small and medium enterprises, and those numbers are produced by the Monetary Fund and the European Systemic Risk Board. The number is astonishing, and I am, shocked at the difference. I mean, it looks like, a small difference, but imagine that you are going to buy a car, and when you enter, the car dealer shop, you basically have clients paying 5,000 euros or pounds, and then you have clients paying 60,000. So that's the difference that you can see there. So it is important to have an advisor helping not only finding and using the right product, but also understanding the difference in costs and why this is happening. And again, Consumer Duty is exactly addressing this point in terms of fairness, transparency, appropriateness of the products. I have finished here my part. I will pass it to Eszter. And again, thank you very much for following us.
Thank you, Giuseppe. Now, before I begin, let me just draw your attention quickly to the Q&A button on your screen. If you already had some questions occurring to you during the presentation, or if you will have some in the coming part, please note those down in the Q&A section, and we're going to have a few minutes at the end when we are going to look at answering those questions. Now, let me share some information with you about the WieldMore Partner Program, which essentially enables us to provide these services that we are talking about to the benefit of your clients. So who are the participants in the program? Number one is, of course, the client, the small and medium-sized enterprise. Our risk management service is designed to support them. Now, they are now in a bigger need than ever to protect their core business activities from changes in the financial markets. Many of these companies are your clients, and you are providing them with investment advice or accounting services, maybe corporate finance advice, just to mention a few. And I'm sure that you're striving to find the best possible solutions that match their needs. Now, we come in as a partner to you, and we deliver a financial risk management strategy for your clients. We execute the trades, we keep and monitor the positions, we issue reporting. To do that, we use our in-house tools as well as our brokers platform that also acts as the custodian and the safekeeper of the assets for the client. Now, how are we different from other managers? It's important to note, we talked about the team, but let me just emphasize that the individual average years of experience in risk management is above 20 in the team. And our company is fully independent from any other provider. Now, it is not only our expertise that enables us to provide cost-efficient hedging strategies, but also our in-house technology infrastructure, which we're really proud of, that marries quantitative analytical and mathematical expertise with a low-cost, cloud-based, state-of-the-art IT technology. Now, how do we establish this relationship? We laid out a simple path here on these coming slides. First, we provide you with a short questionnaire, which enables us to collect some information about your client's business activities. And based on that, we do a data analysis and create an initial risk assessment. All of that is free. In that initial risk assessment, we highlight what efficiencies could be achieved if we were to deploy a specialist strategy from WieldMore. Now, if your client, if you both find this initial risk assessment interesting and valuable, then we can go ahead establishing a relationship, first of all, with you. We formalize that with an advisor agreement. And it's really important to mention that we are going to be working with you. We'll be sharing our revenues with you. And at the same time, we are going to provide our service to your client. Next step is then to assign a dedicated market specialist from WieldMore to your client and make sure that they are onboarded with us. A part of the onboarding, and very, very important part, is for us to do a suitability assessment and issue a suitability report for the client. And then we also need to have them set up on our broker platform. Once that's done, we collect more information, real detailed data on their business and their business needs, and we use that to come up with the most appropriate hedging strategy, and we provide that as a solution for agreement to your client. Once it is agreed, we go on and execute the trades. After the trades had been established, we provide, obviously, regular monitoring and position keeping services and proactive reporting to your client about how their assets are and how their hedges and how the market is doing, and when we see needs for change. Of course, our specialist is always there to help your client whenever they need them. Now, all that creates, in our view, various different benefits, both for you and your client. First, you get access to the described risk management expertise. With that, if that's not part of your existing client offering yet, then you can expand your offering. You can help your clients protect their business in the current environment. And with that, you can enhance your service to your clients. We help you establish a connection to the financial markets, and very importantly, all that we deliver to you by being an FCA regulated company. And I would say we started with regulations, and we are going to end on regulations as well. And not only because regulations guide us in everything that we do, but also because our company, WieldMore, deeply identifies with the FCA's new overarching requirement of acting to deliver good outcomes for retail customers. In fact, we have already been built on these higher standards, and we're actually quite looking forward to them being enforced by the FCA from next year. So what that means is if you are a regulated financial advisor, we are going to work with you to ensure our mutual compliance with consumer duty, which will obviously benefit all your SME clients. If you are a non-FCA regulated service provider, then you can be assured that your clients' interests are in the center of everything that we do. Now, we are going to achieve all that with detailed and timely suitability assessments, efficient and transparent risk management services, which we are going to deliver at a fair and affordable price. Now, with that, I'm going to thank you for your attention today, and we are moving to our Q&A session. Let me just have a look at the Q&A screen. Someone is asking about, and Giuseppe, this is going to be a question to you, about credit risk.
I think I've seen the question coming, and I think is a very good question, because there is something that we need to specify, and it is the majority of the protection tools that are used in the market to help companies shield the risk for the currencies or commodities or interest rates we talked about are essentially forward contracts. Forward contracts are not regulated and are essentially contracts that are carrying a big credit exposure and credit risk. The contracts we're talking about instead here are listed contracts, which means that the credit risk exposure in this case is limited to the exchange, because those contracts are mainly traded on exchanges. And this is extremely important because the results that we achieve are different and extremely important. The first one is that we reduce massively the credit risk in terms of counterparty risk exposure. The second thing is that using listed derivatives, listed products, those are extremely transparent, are fairly priced, and are also very clear in terms of reporting, because all those points are regulated and the same product is regulated. So from this point of view, I think using regulated products and using listed products is extremely important to address this risk. And again, thank you very much for this question, because I think it's one of the main points.
Thank you. Now, another question is about the free risk assessment. Can we say a little bit more about that? How does it work? What sort of information needs to be provided for it? Giuseppe, I think that's for you as well.
Okay, thank you. I just didn't want to take all the questions and leave a little bit of space for you and Terence as well. But yeah, the risk and assessment and pre-analysis is an important part of what we do. It's completely free. We essentially look at the exposure in terms of what are the needs of the small and medium enterprises. So, the cash flows, the distribution in time, the budget constraints, and the budget plans for the firm. And then we come up with what is our view in terms of, and how we can advise in terms of products and services that can be used to protect those risks. Again, I stress the fact that this is completely free, and it's important for us because it establishes the first relationship between the client and WieldMore. It gives us the opportunity to show how we can assist and what kind of quality of services and product we can put in place.
Thank you.
Thanks.
Thank you. I see another question about whether there are any special requirements, perhaps legal requirements, for an advisor to start working with WieldMore. And
I guess this is for you.
Yes. So I would say that there are no special legal requirements. Of course, it is always going to be an individual conversation that we have with you, and we establish the framework that we follow in our partnership, which is characterized by a specific agreement that we put in place. In these conversations, we will also set out the more detailed operational part of working together. But yeah, long answer short, that there are no specific legal requirements. I don't know if there are any more questions. I can't see any more written. So if not, then I'm going to hand back to Giuseppe, but thank you very much for your attention today.
Thank you, Eszter. Thank you, everybody, for attending this first webinar. We will come back with more webinars in the future. In particular, we will stress again the requirements from the regulator in FCA here in the UK, because I think it's not only a limit for us, but this is for an opportunity. An opportunity to play along the rules and make sure that we can compete with other bigger competitors, and this is what we really are, what we were waiting for, in terms of having the regulator looking after the clients and making sure that the products are going to be more transparent, more fair, and essentially cheaper if it is possible. So that's where we're going. The next webinar will be playing along those lines, so please stay with us, continue to follow our webinar, and one thing that I please recommend is register yourself with our LinkedIn pages, and stay tuned for the next one. Thank you so much, and I'll see you next time.